Okay, I have a number for you, and I want you to really visualize it. $400 billion.
It creates its own gravity, doesn't it?
It does. That's the annual revenue milestone Alphabet, Google's parent company, just smashed through for the very first time.
Which is just staggering.
To put that in perspective, that is roughly the GDP of Denmark or the Philippines. They aren't just a company anymore. They're an economy.
And by all traditional metrics, Wall Street should have been throwing a parade. Revenue up, profits up. I mean, everything looked golden.
But no parade. The earnings report drops, they post these monster numbers, and the market just sort of gasped. The stock actually took a hit at first.
It did.
Why? Because tucked away in the guidance was another number, a number that scared the living daylights out of investors.
Forget about the CapEx guidance, the spending plan.
Exactly. Management announced they plan to spend somewhere between $175 billion and $185 billion in 2026.
Just on capital expenditures.
Just on CapEx. It's a figure so large it almost doesn't make sense. I mean, that's nearly double what they spent in 2025.
It's an absolutely unprecedented amount of infrastructure spending.
So that's what we're unpacking today. Welcome to Griffonomics. This isn't just a standard earnings review. This is an investigative report into what we're calling the pivot.
The pivot.
We're looking at how Alphabet is fundamentally transforming from an advertising monopoly into really an AI-first infrastructure utility.
And the big question, the one that decides if this stock is a buy or a sell, it's pretty simple. Is this cash cannon strategy building an unassailable moat that no one can cross?
Core.
Or are they just burning cash too fast in a panic because they're terrified of the competition?
Let's start with the source of the cash before we get to the fire hose. For the last 2 years, the big story in tech has been AI is going to kill search.
Oh yeah, that narrative is everywhere. ChatGPT, Perplexity.
Right. Why would I hunt through 10 blue links when an AI can just give me the answer?
It's a compelling narrative. And logically, it seems to make sense. You get the answer immediately, you see fewer ads.
Then if you see fewer ads,
Google's revenue collapses. But if you actually look at the Q4 2025 data, that narrative just hits a brick wall hard.
so the rumors of Google's death were greatly exaggerated.
Wildly exaggerated. Look at the numbers. Search and Tupra. Other revenue hit $63.1 billion.
In the fourth quarter alone,
Yes, and that's growing 17% year over year.
17% growth for a business that mature, that shouldn't be possible. I mean, usually when you get that big, you're growing at, what, 2 or 3%?
Exactly. This engine is not sputtering, it's accelerating. And if you look at total Google services, that's search, YouTube, Android, all of it, it reached $342.7 billion for the year.
But help me reconcile this. I use chatbots, you use them. If everyone's shifting to AI, why is the search bar still printing money?
Because the behavior is shifting, it's not disappearing. We're seeing a shift to what they're calling agentic search. It's not just keywords anymore. They introduced this AI mode, and the data shows that queries in this mode are 3 times longer
3 times longer.
and significantly more complex than a traditional search.
So people are treating Google less like a library index and more like a research assistant.
Or a personal shopper. And this is where the monetization gets really interesting. You might think, okay, complex questions are bad for business, they're harder to answer.
Right.
But Google is rolling out something called the Universal Commerce Protocol.
That sounds incredibly corporate and a little bit sci-fi. What does that actually mean for me, the user?
It means the AI doesn't just show you a pair of sneakers. It's an agent that can execute the whole shopping transaction, from discovery all the way to checkout.
It closes the loop.
Wait, so instead of clicking a link, going to a website, adding to cart, entering my credit card.
The AI just does it.
Wow.
That's the goal. And if they pull that off, the value of that single interaction skyrockets. The CEO, Sundar Pichai, he called it an expansionary moment. So users aren't searching less, they're just searching for more complex things.
Exactly. Which means the cash cannon is safe.
It's more than safe.
It's the engine that funds everything else we're about to talk about. Without search printing money like this, they couldn't possibly afford the pivot.
Okay, so search pays the bills, it's the steady paycheck. But the cloud seems like the rocket ship.
It is absolutely the new growth engine. We've been watching Google Cloud for years, honestly, just waiting for it to really catch up to Amazon and Microsoft.
And Q4 2025 was that moment.
It was the inflection point. The numbers here are, well, they're kind of mind-blowing. Cloud revenue surged 48%.
48 to 17.7 billion in the quarter.
Yep. That puts their annual run rate over $70 billion. Just a few years ago, people were asking if Google should just spin off the cloud business.
Because it was losing so much money, right?
They were burning cash just to acquire customers. And now?
Now what?
Now it's a profit machine. And this, to me, is the most impressive metric. The margins. Operating margins for cloud expanded to 30.1%.
Whoa.
They made $5.3 billion in profit just from cloud in one quarter.
That is a huge swing. They went from losing money to 30% margins. Is it just because they have more customers?
It's scale, yeah, but it's also efficiency.
Yeah.
They're going faster than both AWS and Azure right now, and they're improving profitability at the same time. It's incredible.
And there's more to it.
Oh, yeah. If you want to know where this is all going, you have to look at the backlog.
The backlog.
The revenue backlog. These are the signed contracts for future services. That number doubled year over year.
To what?
To $240 billion.
$240 billion in committed spend.
That is correct. That represents huge enterprises locking themselves into Google's infrastructure for the long haul. And there's one partnership that, it validates this entire tech stack on a massive scale.
You're talking about Apple.
Yep, it's confirmed. Google is the preferred cloud provider for Apple, and they're embedding Gemini into 2.5 billion devices.
That is just wild. So when I use AI on my iPhone or Siri pulls some advanced data,
There's a very good chance it's running on Google's Metal.
that's a massive validation. Apple is notoriously picky about privacy, speed.
Everything. So if they're trusting Google's infrastructure for their own foundation models, it sends a huge signal to the rest of the enterprise world that this stack is rock solid.
But that brings us back to the metal, because you cannot service Apple and all these enterprises and billions of search users without just a staggering amount of physical stuff.
Which brings us right back to that scary number, the $180 billion gamble.
The sticker shock.
Right.
So they're planning to spend up to $185 billion in 2026. For context, they spent about $91 billion in 2025.
So they're doubling down.
Literally. Where is all that money going? Are they, I don't know, buying small countries?
It breaks down to roughly a 60-40 split. About 60% of that cash is going to servers. So technical infrastructure, all the specialized chips.
And the other 40?
The other 40% is going to concrete, data centers, land, networking equipment, the physical buildings.
But why? Surely they have enough data centers by now. Google has been building the internet for, 20 years?
Sundar Pichai was very, very blunt about this. He said they are supply constrained.
Supply constrained. Google. That feels like saying the ocean is running out of water.
It sounds completely absurd, but the demand for AI compute, both from their own products like Gemini and from their cloud customers, is higher than what they can physically provide. They are sold out.
So if they don't build it, they just lose the business.
Right. If a company wants to train a massive model and Google says, sorry, we don't have the GPUs available, that customer just goes to Microsoft. They have no choice but to build.
But there has to be a strategy here beyond just, keeping up with demand.
Absolutely. This is about building a compute moat.
Explain that concept. A compute moat.
Think about the barrier to entry. If the table stakes to compete in AI are spending $100 billion a year on infrastructure, who can afford to even sit at that table?
Microsoft, maybe Amazon, and that's it. That's the list.
Exactly. By spending this amount, they're creating a world where no startup, no mid-sized tech company can possibly compete on the infrastructure level. They're turning AI compute into a utility that they own.
But this has to hurt the bottom line in the short term. You can't spend $180 billion without feeling it.
Well, it will hurt. We are absolutely going to see margin compression, depreciation expenses. Just the cost of writing off all that new equipment rose by nearly $6 billion in 2025.
And that's going to skyrocket.
Skyrocket is in 2026. And free cash flow. Usually Google is this cash-generating monster.
Yeah.
It still's operating cash flow is $165 billion. But the free cash flow will likely stay flat or even dip because they are pouring almost every single cent of it back into the ground and the silicon.
Okay, so they are betting the farm. But this is where Griffonomics gets specific. They aren't just buying NVIDIA chips like everyone else, are they? That feels like a key part of this whole thing.
It is the most critical part. This is about vertical integration. If you're buying all your chips from NVIDIA, you are paying the NVIDIA tax. You're paying their margin.
And Google has been making its own chips for a while now.
Since the beginning, practically. They just introduced the 7th generation Ironwood TPUs.
TPUs tensor processing units.
Right. And here is the stat that should make your jaw drop. These custom Ironwood chips reduce the cost of serving the Gemini model by 78% in 2025.
Wait, 70? Say that again?
78%. Imagine if your main competitor had to pay $1 to do something and you only had to pay 22 cents.
That is the advantage.
That is the advantage Google has by owning its own silicon.
That is a massive edge. It explains how they can afford to put AI into everything, while others might hesitate because the cost is just too high.
It's the difference between a viable business model and a money pit. But there's another bottleneck. You can build all the chips you want, but if you can't plug them in, they're just expensive paperweights.
Power. I keep hearing that the grid is full.
It is. Data centers are incredibly power hungry, which is why Google made a very interesting acquisition recently. They bought a company called Intersect for $4.8 billion.
Intersect. I haven't heard much about them.
Most people haven't. They specialize in data center and energy infrastructure solutions. So Google isn't just buying real estate, they're buying the expertise to manage the power grid itself.
And on top of that, I saw a headline about a massive power deal. Almost $10 billion.
A $9.9 billion power deal. It's a 20-year agreement running from 2027 all the way to 2047.
That is a long commitment.
It is. They are locking down the power from a major plant to ensure they have energy independence. They can't be at the mercy of the grid.
So let's just look at the full stack here. This is what you mean by from atoms to algorithms.
Yes, they own the energy, right, through the power deal.
Yeah.
They own the infrastructure expertise through Intersect. They own the physical data center. They design the custom chip, the Ironwood. They own the AI model Gemini. And they own the distribution search in Android.
No other company has that level of complete vertical integration. I mean, even Microsoft relies heavily on OpenAI for the models and NVIDIA for most of the chips.
Google's doing it all in-house. It's risky, sure, because you have to be great at everything, but if it works, the efficiency gains are just unmatched.
It's an empire. But we can't ignore the other parts of that empire. What about YouTube? Is it just cat videos and podcasts like this one?
Far from it. YouTube is a $60 billion economy on its own. That's combining ads and subscriptions.
60 billion. That's bigger than most major media companies, bigger than Warner Bros. Discovery.
It is. Ad revenue alone was $11.4 billion in Q4, and that Nielsen data confirms it's still the #1 streamer in the U.S.
Beating Netflix.
Beating Netflix in terms of total watch time on TV screens.
That's impressive. And then there are the moonshots, the other bets. We usually gloss over these because they lose money, but something stood out to me about Waymo this time.
Waymo is finally starting to look like a real business. They are now providing over 400,000 weekly paid trips.
That is a lot of robot taxis. That's not a science experiment anymore.
No, it's a commercial service. However, it's incredibly expensive. There was a financial charge in Q4 related to Waymo stock compensation.
Ah, paying to keep the talent.
Exactly. Retaining the engineers who can build self-driving cars can't be cheap. But again, Waymo benefits from the exact same infrastructure spin we just talked about. The TPUs, the data centers, it all feeds back into the autonomous driving models.
Okay, so let's zoom out. We have the cash cannon of search funding this massive build-out. We have cloud growing at 48%. We have a $180 billion spending spree to build a moat. What's the final verdict here? Is this insanely risky or is it genius?
It's a bit of both, but mostly it's a necessity. The rating from the experts we looked at is a high conviction value buy. They call it GARP growth at a reasonable price.
But the risk has to be mentioned.
The risk is all execution. Can you actually deploy $180 billion efficiently? That is a logistical nightmare. If they waste just 10% of that through inefficiency.
That's $18 billion flushed down the toilet.
It is. But the reward is an unassailable, utility-like dominance of the entire AI era.
So what does this all mean for you, the listener? Why should you care about Google's CapEx?
I think it raises a fascinating question about the future of the internet itself. Think of it this way. If data centers and compute are the oil refineries of the 21st century.
Okay, I like that analogy.
And Alphabet is building the largest, most efficient refineries on the entire planet. Does it really matter which AI model wins today? Does it matter if ChatGPT is slightly better than Gemini this week?
Because eventually they all need to use the refinery.
Exactly. If you own the infrastructure, the house always wins. They are betting that the physical reality of computing, the power, the concrete, the silicon, is ultimately more valuable than the software running on top of it.
That is a heavy thought. It's not about who has the smartest chatbot. It's about who has the biggest generator.
In the long run, usually yes. They are securing the supply chain for intelligence itself.
Well, on that note, I'm going to go check my Google Drive storage limit because apparently that's where all the money is going.
Probably a good idea. Every gigabyte helps pay for that new power plant.
Thanks for listening to this deep dive into Griffonomics. We'll see you in the deep end next time.